So the fourth entry, so I think one of the fourth entry, I got in on the fourth entry, I got taken out. Price took me out. I took one loss on that fourth entry. So right here was the fourth entry. Now this, you can see this gap right here. After we mitigated this gap, I saw a 5 minutes break of structure here, and then price eventually came back down to wipe my stop. Now, after my stop loss was taken, what I was wondering was why did this come back to take my stop loss when it already mitigated that area, broke structure, and then instead of rallying, it just went straight down to my stop loss. What happened? What did I do wrong? And that was when I realized that I got manipulated out of the market by the broker I was using. So this one is FX open, and you can see that we didn't tap into that opening range gap with this low right
Yeah.
here. You can see the
Yeah.
low right here. We didn't tap into that opening range gap. And because we didn't tap into that opening range gap, there wasn't any need to buy it. But I didn't see this in the broker I was using. So for example, if you go into this broker, so this is 8 cap, you can see that on 8 cap, that area, that gap was already mitigated. You can see that, right?
Yes.
And after that mitigation, we now broke structure on the smaller time frame. We broke structure after that mitigation, and right here was the break of structure. A high, a low, a break of structure here. So it's ideal to anticipate for a retest to buy if you're using this analysis. But what I didn't realize was that this was only on 8 cap. There are other brokers that price hasn't mitigated that position. So if I if I had looked at FX open, I wouldn't have bought from here. I would have just been on the sidelines because we didn't mitigate the point of interest. So why would I buy? Does that make sense?
Yes, boss.
But eventually, like I was saying previously in the beginning of this session, we will always make mistakes because we're human beings. We're
Yeah.
human beings. We're always going to make mistakes. We're always not going to see some things. And that is why it's essential for you not to just look at data off just one broker. Always have a second opinion after you've analyzed it on, let's say, on Oanda or 8gap or FXCM. Always have a second opinion, another broker you will use to confirm that everything aligns perfectly before placing that trade. So for my fourth entry, what I now did was after this one took me out, the next thing I did was I waited to see a mitigation in here. And after price tapped into that position here, took my stop loss, which was resting right here, mitigated this gap. The next thing I wanted to see from here was either 15 minutes or a 5 minutes break of structure, and then I'll buy it. And as you can see on 15 minutes time frame, we'll have a high, we'll have a low, and then we'll broke structure. After we broke this structure, all I did was I just placed my limit order on this high. And you can see how price literally tapped me in, and there was literally zero drawdown on that trade, and we rallied. And this is part of the reason why I will always prefer to use the high as my entry over using a Febly gap or last down close candle. Because imagine if you were waiting for price to mitigate, for example, this Febly gap, you would have missed the trade.
Yes, sir.
And you see those instances, this is part of the reason why I will always prefer to use the high as my entry because I've missed countless trades trying to always use the Febly gap or last down close candle. So they all have their advantages and disadvantages, but if you're using the high, you'll be in more profitable positions and your risk to reward will be a bit lower. If you're using the Febly gap, your risk to reward will be higher, but you miss out on so many trades. And when you do the math, you realize that using the high will be a much profitable entry model.